Hey guys, you want to hear something crazy? Imagine you work your whole life, save up a bunch of money, and when you pass it down to your kids, the state takes a piece of it. Pretty insane, right? But that's what happens with something called inheritance tax. And if you live in Pennsylvania, this applies to you. Hey guys, I'm Tom, a certified financial planner, and I just had this exact conversation with a client who inherited money from his dad last week. And now he wants to make sure his kids don't get stuck with a big tax bill later. So in this video, I'm going to explain how Pennsylvania inheritance tax works in the simplest way possible and how you can plan ahead to make it easier on your family. We'll cover what inheritance tax actually is and how it's different from a state tax, the percentages depending on who gets your money, a few smart ways to reduce or plan for it, and common mistakes I see people make. So let's start with the basics. What is inheritance tax? When someone passes away, the money, their property, houses, car, or bank accounts all go to the people they choose, also known as beneficiaries. But in Pennsylvania, the people who receive that money might have to pay a small part of it to the state. That's called inheritance tax. Now, how is this different than a state tax? A lot of people get confused here, so pay attention. A state tax and inheritance tax sound the same, but they're not. A state tax is a tax on the person who died's money before it was given away. Inheritance tax is a tax the person receiving the money has to pay. And good news, Pennsylvania doesn't have an estate tax, but it does have an inheritance tax. Now, here's where most people's eyes glaze over, but stay with me because I'll make it easy. In Pennsylvania, how much someone pays depends on who they are to you. So let's say a dad passes away and leaves $2 million to his family. If it goes to his wife, she pays $0, no tax at all. If it goes to his kids who are grown adults, they pay 4.5%, which means about $90,000. If it goes to his brother or sister, they pay 12% or about $240,000. And if it goes to a friend, they pay 15% or about $300,000. And if anything is left to charities, that's also 0%. They don't pay any tax either. So the closer the person is to you and family, the smaller the tax. The farther away, the bigger the tax. Now, the good news is there are ways to plan for this. Here are a few simple ones that I want to go over with you. Give gifts while you're alive. You can give up to $19,000 per person per year without any tax. Or if you're married, you can give up to $38,000 to any individual and to as many people as you'd like. There's no limit on this. So it's like handing out smaller pieces of your pie early, so there's less to tax later. And I talked about this with my client and how much more fun this is because rather than leaving all of your wealth and assets to your family beyond the grave, give some of it away now if you can, so you can enjoy it and see them reap the benefits. Help your grandkids pay for college, get their first car, help with their first home. These are some of the ideas we were discussing, and he started to get excited about it because his kids were getting married and he knows he's going to eventually become a grandfather. So give as much away as you can when you're alive. There's also joint ownership, and this is a specific way you title your accounts. If you have a joint account with rights of survivorship with your spouse, it passes tax-free. If you have a joint account with your adult child, your child would owe inheritance tax on 50% of the account's value. So if you had $100,000 in a joint account with your son, $50,000 would be subject to the 4.5% tax. And it would work the same way if the child passed away on the joint account and the parent was getting the money. Now, in addition to this, what's also really important to know is that the assets in the joint account receive a step up in basis, which can reduce capital gains later if you decide to eventually sell the investments within the account. Next is life insurance. Very simply, the beneficiaries listed on your life insurance policy will not pay PA inheritance taxes. In fact, using life insurance is a common way to help your children or heirs cover the PA inheritance taxes without being taxed itself. So you can own a policy on your life, have your kids be the beneficiaries, and when you pass away, they each will receive a split of the proceeds depending on how much you chose to allocate between them, and then they can use the proceeds to pay the inheritance tax on the other assets. Then we have charitable giving, where we can leave some money to certain causes and qualified charities you care about, and that portion can reduce the overall tax burden. And finally, just start early if you can. Because if you wait too long and give away money less than a year before you pass, Pennsylvania still counts it as part of your estate for tax purposes, so don't wait until the last minute. Now let's go over some of the biggest mistakes I see all the time and how to avoid them. First, not updating your beneficiaries. This one happens a lot, and this is a big one. Life changes. Maybe you got divorced, remarried, or have a blended family. If your life insurance or retirement accounts still list an old spouse or someone you no longer want as a beneficiary, that's who gets the money, even if your will says otherwise. So check and update your beneficiaries regularly. Waiting too long to gift. In Pennsylvania, gifts made within 1 year before you pass away can still be taxed. That's called the look back rule. There's also a small $3,000 exemption for last minute gifts, but beyond that, the full amount can count towards inheritance tax. So the lesson, again, start early. Small gifts over time add up and keep your taxable estate smaller. Adding a child to your bank account. Now, this might seem simple. I'll just add my kid to the account so they can help me pay my bills. But unless you can prove that your child actually contributed their own money to that account, rather than 50% being subject to the inheritance tax, the entire balance could be taxed when you pass. Forgetting about out-of-state property. So this could be another one. Again, if you own a lot of property out of your home state, that state might have its own rules and taxes. So what works in Pennsylvania might not work for your beach house in New Jersey or your cabin in Maryland. So make sure your estate plan covers all properties you own. At the end of the day, inheritance tax is Pennsylvania's way of taking a small slice when money moves from one generation to the next. It's not fun, but with the right planning, it doesn't have to be painful. So talk with your advisor, start early, and make sure your plan covers things like life insurance, gifting, and property in other states. If you need help, click the link below the video and I'd be happy to chat. I'll see you in the next one.